webcast is now starting. All attendees are in listen-only mode.
All right. Good afternoon, everyone. Welcome to our Investors Observer Members Only Workshop. My name is Bobby Rains. I am here to talk to you about the economy, the stock market, Investors Observer. Well, maybe not anything else you have questions about, but certainly a large portion of the presentation today will be questions from the audience. I got a few ahead of time, so thank you for those. Otherwise, if you have a question at any point, just throw it in that question box. I will either get to it at the end, or I do get to some of them sort of as we're going along. All right, so this is our agenda for today. We're going to look at some charts, talk about a bunch of other things that are happening, look at what sectors and industries are hot right now in the market, and then the rest is, like I said, that member-driven content. I got a few questions ahead of time, but any other questions you have that you would like to have answered about, stocks, the economy, Investors Observer, any of those things, by all means, put them in the box and I will get to them as we go. All right, so we're going to start with charts. This is the S&P 500, 1 year. We're back basically at all-time highs. Plus or minus, I think the Dow hit a new high today. I don't know if the S&P quite made it there. I didn't see the last few minutes. But yeah, for all intents and purposes, back to new all-time high. The last time we talked, we were, I think, had just bounced off the 100-day moving average here. So, it's been a bit of a ride, but sort of recovered and gained some momentum, and now things are moving in the right direction. All right, the NASDAQ is not as close to a new all-time high, and we'll probably talk about that for some reasons for that later, but it is, again, moving in the right direction. It did kind of a similar thing if you want to look here in terms of going down and spending some time on either side of the 100-day moving average, which is that white line, and then, finding strength, getting it together and rallying back. The Russell is still in this range it's been in basically all year. These are your small cap stocks. However, it is interesting and potentially a positive that it didn't go down to the bottom of this range like it has some number of other times here recently. It's been pretty steady and sideways, and now seems to be sort of building a base with everything else. So hopefully earnings and a few other things will maybe help the small caps break out there too, and we'll just have a broad-based rally into the rest of the year. We'll see. All right, S&P 500 versus the S&P 500 equal weight. This is a chart we like to look at because it shows basically the strength of what I'll call the S&P 495, which is, the S&P 500 without your Apple, Google, Facebook, Tesla, those top several stocks are all tech, and they can kind of distort the market because they just account for so much of it. Since the last time we talked, they've been pretty sort of in step here. I would say, as far as the chart matching, they're not getting closer together or further apart. So that's, maybe neither positive or negative, but it does suggest that the rally is pretty broad-based and not, not either a bunch of big stocks or a bunch of smaller stocks moving the broader indices. Growth versus value, we've got, again, both, making good headway. Growth tends to be more volatile, so it's not surprised that it went down further. But it also tends to be, more volatile to the upside as well. So it should, if we keep with this rally, we will, we'd like to see growth sort of overtake the value stocks there for it to keep going. But value at a new all-time high, growth not quite there yet. All right, so this one's kind of interesting. JETS is a big airline ETF, and FANG is that Facebook, Apple, Amazon, Netflix, Google, and then there's a couple other things thrown into this index as well. FANG has done well recently. Jets, interestingly, seems to have sort of bottomed out about the time the rest of the market, or topped out the time the rest of the market sort of bottomed out. So that's kind of interesting. But yeah, I'm not real sure what to make of that, other than that the airline business is, the airline business is one that runs on tight margins in the best of times, and obviously, restrictions on travel aren't good for an airline, but also, rising fuel prices as the economy starts to reopen can be a problem there as well. So, I think there's a lot going on with the airlines. All right, so let's talk a little bit about inflation and stocks. This is a pretty popular topic right now, and I have said a couple times that I don't think inflation is bad for stocks, but I wanted to kind of put some examples together to explain why. So let's imagine a company that has $10 in revenue and $8.50 in expenses. That gives it a profit of $1.50 and a 15% profit margin. Okay, so with 5% inflation, you have $10.50 in revenue, right? We'll multiply the expenses by 5%, you get 8.925, margin stays the same, profit goes up, right? In line with inflation. That's not a problem for stocks, right? Like, you multiply the stock by some percentage of what you expect forward earnings to be, the multiple probably stays the same. The earnings go up because it's a figure that's based in dollars. So even if the value of the dollar goes down, you're still talking constant dollars, no problem. Now, a more realistic company is going to have some fixed costs, right? You're not renegotiating your office space on a weekly or monthly basis. That's usually a years-long lease, right? Any sort of capital you own, there's some replacement costs or things like that, but a lot of those expenses aren't there. Wages, you're probably not just giving 5% across the board wages to the entire workforce. New people coming in might make a little bit more than people who started a couple years ago did when they come in. But yeah, all of your expenses aren't going to go up by that 5%. So let's say half the costs are fixed and the others still go up. So now expenses only go up to 8.7 and profit goes up. Margin is actually expanding in this case. So inflation is not necessarily bad for stocks, is really the point here. Real companies are way more complicated than this, obviously. But generally, broad-based inflation shouldn't be bad for profits. The reason I say broad-based there is obviously we're dealing with a situation where there's shortages of things. If you can't get the raw materials you need to make your product, or if those materials, costs go way, way up, then you have some problems. But just generally, broad-based inflation shouldn't necessarily be bad for sort of a broad-based portfolio of stocks. Now, what can be bad for stocks are anti-inflation efforts, actually, right? Monetary policy levers slow the economy down. That is the point, right? We lower interest rates when the economy gets bad to try to speed it back up. We raise them a little bit when inflation gets high to try to slow the economy down. So there have been lots of good arguments over the years that low rates and quantitative easing don't help stimulate broad demand. I think that's generally true, right? They tend to stimulate demand for financial assets, which makes financial conditions very easy. Companies can borrow money to finance new projects. Stock prices get high on an earnings base, or on a per earnings basis, which means if you want to raise equity capital, you can raise a lot more dollars without diluting your existing shareholders as much, right? Like, their money gets very cheap, asset prices go up. It doesn't necessarily stimulate demand for things that well, but tighter policy does tend to suppress demand. Higher interest rates, things like housing and cars, people really notice that. I don't know anybody who necessarily buys a house just because interest rates go up, or buys a car or goes down, or just because buys a car just because interest rates are cheap. But people will definitely think twice about those transactions if rates are rising. And so, yeah, what people with lots of stock exposure really want to worry about on the inflationary front is less the actual inflation and more the sort of anti-inflationary measures. Now, the Fed is going to raise interest rates at some point. I'm not saying like, sell your stocks before the Fed raises interest rates, but inflation by itself is not a problem. Where we can get into a problem is right, like anytime you're trying to manage inflation without causing a recession, um, you're sort of walking a tightrope there because you're trying to slow things down, but not too much. All right, so supply shortages, another thing we hear a lot about lately. There are lots and lots of moving parts to all these supply shortages, but they exist for sort of two basic factors, right? You have some rolling shutdowns in various places due to COVID. Some places have had some flooding and things like that. Some places had some droughts and they have water, water heavy industries, other natural disasters. All of those things happening, any one of those things may be not a global problem. All of those things happening, you get some real weirdness and lots of problems. The other thing is demand for shipping is well above pre-pandemic levels. People converted a lot of spending on services to spending on goods. I heard some stuff earlier this week that somewhere between like 17 and 20% more stuff is coming through Long Beach and LA, which are the two big West Coast ports, than pre-pandemic. And yeah, most places don't have an extra 20% capacity. So things just get squeezed right there because of that. And yet the supply shortages kind of have to work themselves out, right? Like some manufacturers are using alternative sourcing. Some are changing how things made. I think General Motors, it might have been, said a couple weeks ago that they're going to start putting in a less electronic rear view mirror, right? So I don't know that anybody's buying a new car because it has an electronic rear view mirror. I don't know that anybody isn't buying a new car because it doesn't have an electronic rearview mirror, but that is the kind of thing that you might see get sacrificed a little bit. And the other thing is that things cascade, right? So the processor shortage is hurting other sort of chip and component makers. Micron has said that there's decent demand for their products from the end user. The problem is nobody just buys a bunch of memory. What people buy is a computer. And you can't make computers if you don't have the processors and the graphics chips, which are what are in short supply right now. And so theoretically, right, there's a lot of there's plenty of supply of memory that Micron makes. There's plenty of demand on the other end for computers. What's missing is some of the other pieces. And so yes, some industries are basically getting everything ready so that when they can get their shipment of processors or whatever, they can plug them in and have a bunch of products go out the door. So there's a lot of things where this could improve, but yeah, all these things cascade also, right? So we'll talk a little bit later, a little bit more about this energy crisis, but there's a coal shortage in China. So China starts importing natural gas. Gas gets expensive or even short in Europe, so they switch to using oil. So then oil gets too expensive for certain other applications. So now you've got this whole cascading thing that has moved across the world because China was a little short on coal, right? Now you've got problems all over the place with the energy market, and even oil gets expensive, more expensive onshore in the United States. It's these localized problems because everybody was kind of running on they used to talk about lean manufacturing. Everything is sort of just in time and just enough, and that's great and super efficient when there's no hiccups or bumps in the road. But if you have a couple bumps in the road and maybe a hiccup or two, now the whole thing fell apart. All right, and yeah, shipping is a whole other deal. Right, it's one, incredibly complex. And we're starting to see some things where instead of just going to Long Beach and LA, some ships are starting to go to smaller West Coast ports. I'm going to Seattle, places like that. Some are even going through the Panama Canal and coming all the way around to Savannah or some other East Coast ports. But there's a ton of onshore issues. Right, so you get a container ship that comes into port, cranes take the containers off the port and they put them sort of around the port facility. And then the person who ordered the stuff in the container is responsible for coming and getting that container and taking it off the port. And that's not happening to some degree. So ships can only be unloaded as fast as the containers can be taken out of the port facility. And so there was an announcement earlier this week that Walmart and some other retailers would start picking up their containers at night. But so far, reports from people in the shipping industry are that's not happening very much. But if you think about that and think about what that means, right? Like, oh, just come get your containers at night. We don't really want to do that. I guess we'll do it. One takeaway from that is maybe some of these big companies don't feel like they need the supply issues to go away that badly, right? Like if your choices are empty shelves or get these containers out of the port, maybe you hurry up there. But it seems like maybe Walmart is fine if they have to be cajoled into, having people drive in the dark. As to likely outcomes, some things are going to remain hard to get, both because of that, all those supply shortages, but also because of the shipping things. Where I really expect this to show up, especially as we head into the holiday season where people are concerned about it, is, and we're already seeing with new cars a little bit, right? There's not a lot of discounting going on in new cars. Those of you who watch sports, especially the NFL, usually it's, beer and truck commercials. There's fewer truck commercials, and also they're not advertising the dealer rebates and things that they have in years past. And that's because they're selling all the cars they can make at full price. And in some cases, maybe even above the sticker price. So what you might see in terms of how that shows up in financial results, which is, I'm talking to investors, that's what we actually care about here. Right, I think most of the big companies will be fine. And what happens is maybe you sell fewer units, but you sell them at a higher price. We may see fewer of those, doorbuster, Black Friday kind of things. But yeah, right, less discounting, sell things at a higher price. Probably, for the most part, comes out in the wash. Smaller companies, I think, are going to have a harder time. And that's because, if you make widgets, would you rather fill 10 orders for 100 widgets or one order for 1,000 widgets, right? Like, if you just want to fill the big orders first, those are your biggest and best customers. You treat those people well, and then the smaller customers sort of get the scraps sometimes. So I think that's kind of how this is going to shake out for the next couple of months. I know there's some things that are happening, right? Like keeping the gates open so trucks can come into the ports 24 hours a day will help if the trucks actually come. I was just, reading some stuff before this started. Some people from a big logistics firm were at the ports last night, and there just weren't trucks coming. So they're, waiting. But whoever is ordering these containers is not really interested enough in finding a truck and getting it to the port. All right, so how is earnings season going? Some hits and some misses, obviously, but generally it's going pretty well. The S&P 500 is on pace for the third highest profit margin since 2008, right? That things are looking fine from that perspective. There's lots of positives about the future. We talked about airlines being down recently, but the other side of that coin is if you look at what they're saying during earnings, they're all talking about adding capacity, expecting more travel, including, the big legacy carriers are very excited about international travel coming back in 2022. Things are generally sort of looking good there. Everybody's always talking about costs. I think they're talking about it more this time around than other times. But yeah, lots of companies are mentioning higher costs for either labor or raw materials. Pricing power, though, remains to be a thing, right? Like companies do seem to have pricing power. Nobody really wants to raise prices because you're always worried about, well, if we raise prices, will people buy less? But not many are reporting a lot of problems when they raise prices. And yet most constraints on sales are related to supplies, sort of tying into the shipping thing we were just talking about. J.B. Hunt is a big logistics trucking company. They run a lot of trucks around. they reported margins are up, demand is up. Where they're running into a problem is finding enough trailers to carry stuff around in. So yeah, right. Like there's all kinds of stuff that people want all of a sudden, and the capacity to move it around isn't there. So that shows up in all kinds of places. But yeah, I mean, JB Hunt had better than expected earnings. They said, our rates are higher than they've ever been. Where we're, losing out, if we're losing out anywhere, is volume, and it's because people want us to haul stuff and we don't have trailers to haul the stuff in. All right, what else is going on? The Fed, or as we always say, really guesses about what the Fed might do, is still driving markets to some degree. It's been interesting to see the action in bonds recently. I don't know if anybody's noticed, but especially the shorter term bond rates have started to rise a little bit in the last couple of weeks. That taper announcement is going to be, if I had to guess, I'd say the November Fed meeting. Interest rate hike probably late next year, depending on the data. The interesting thing about being a central bank and setting interest rates is that signaling about policy functions the same as policy. So telling the market you plan to hike will make rates go higher. This chart is small. I know it's hard to read, but it's really here just for sort of an example. So the yellow, green, I'm not sure what color that is. That line is the actual Fed funds rate. These other little lines that come off of here are how the market was pricing Fed funds futures for all of the recovery from, going into 2008, the recovery from 2008, and then afterwards. And what you see is they always aim high, which means that short-term interest rates, sort of in that gap between, the sort of area where, money market funds and other things are active, overnight and other short-term lending, were higher than the Fed set rates, because the Fed said, hey, we're watching this. We're going to start liftoff as soon as we feel like it's necessary. And so nobody wanted to be behind the curve on the, fund manager side. So everybody, just acted like rates were higher all along. So saying you're going to raise rates will cause rates to be a little bit higher, but you don't actually have to raise them. Right? So that's what I mean when I say signaling about policy is policy. If you say a thing is going to happen, the market will price that in. And so that gives you some kind of flexibility, and you can, as long as you're saying the right things about inflation, things will tighten a little bit, and then, obviously you can raise rates when you need to. Yeah, the energy crunch is another interesting piece. Coal in China, gas in Europe, oil everywhere. It spreads to other commodities. China shut down some aluminum smelting plants to try to save energy. So, now you're looking at less aluminum. In Europe, they had to shut down some fertilizer factories. So you're looking at, higher prices for fertilizer, which likely leads to higher prices for food and other crops at some point. China's working to fix the coal issues. Honestly, I think one potential bright spot is the, I don't know if you remember several weeks ago, everybody's worried about this company, China Evergrande. And will they make their bond payments and things like that? It seems like what's happening is they're keeping that contained, but there is going to be some slowdown in the real estate development sector, which probably frees up some commodities for some other places. So hopefully that will be, I don't think it's enough to actually fill the gap everywhere, but I do think it helps a little bit. And then, yeah, I mean, COVID is obviously still the thing, right? Like I'm still talking to you from my house instead of my office. But everything seems sort of pointed in the right direction. Cases keep going down. No new variants have emerged. It seems like what's probably going to happen is we'll reach some, let's call it baseline level of infection, and then new treatments and rising vaccination rates make future outbreaks less dangerous. At that point, everybody just kind of has to figure out what the new normal looks like, right? Like we've talked about this here at Investors Observer, and I'm probably not going to work in the office 5 days a week, every week, just as a baseline expectation, maybe ever again. It turns out it's not necessary. I can save on gas. I get, 30, 45 minutes back on either side of my day in terms of a commute. There's all kinds of things that happen there that make it nice. I do like working in the office. Right now I'm doing it once or twice a week. So it's nice, but I don't have to be there every time. But what that means is that sort of downtown business district where my office is, how many restaurants can stay in business if I'm down there twice a week instead of 5 days a week? So some things like that will probably have to shift around and get figured out at a certain point. And that's why I say figure out what normal looks like, right? Like I don't think there is a day that happens where people just declare pandemic over and everything goes back to the way it was before. It's been too long. That's not going to happen. All right, so sectors and industries that are hot right now. Energy was, I think, second place last time, up into first this time around, and it's thermal coal, which is, like I said, mostly a China story. But coal is a global marketplace, so coal gets expensive in China. People start sending their coal to China. Coal gets expensive everywhere. Oil and gas also high for reasons we talked about. Exploration and production and the diversified players are both rising there. Real estate slid from 1 to 2 this time around. Residential is still on top, but the hotel and motel REITs have really started to pick up. They show up in our list of top sectors and industries now. The diversified REITs are still there. Developers, companies that do sort of a collection of things that maybe don't get all their revenue from any one line of business. And then the industrial REITs, which is a lot of warehousing and storage, is what that's about. Financial services, regional banks and diversified banks, those have been on the list for a while. Asset managers were near the top of this list on financial services last time we talked. It's banks now. I think a lot of that is earnings. I think a lot of that is also interest rates and the economy getting better. Asset managers are fine. They just collect fees. It's not a bad business to be in. Somebody gives you a bunch of money to manage and you take a little bit. And if you make them some money, you take a little bit more. It's a pretty great business, especially when stocks are going up. But when the economy starts to heat up, things like banking start to do well because, they take a tiny piece of every transaction. Industrials come up next. Uranium has kind of its own things going on. But staffing and employment services and rental and leasing services, right? Like people are hiring and they're trying to move their stuff around. That's the story there. And then consumer cyclical, this is interesting. It kind of ties in with the REITs, right? It's lodging and travel services, and that bumped off. I think it was apparel and footwear were in those two slots last time around. So people are making plans. They're starting to move around again. There's something going on between, the airlines are all very optimistic, but if you look at the hotel motel REITs and the lodging and travel services sectors, all those stocks are moving in the right direction. So I think people are starting to feel pretty good about reopening again. And just so you know, where I get this data is from these sector and industry pages. So what I usually use for the hot right now is the short-term technical score. So this looks at price action over the last months of all the stocks and then aggregates it together by sector and industry. You can use any of our scores if you want. You want to know what industries analysts like the most right now? It's healthcare. You want to know, you're looking for value plays, right? Like, it's the same scoring system you find on the individual stock pages. This is just a different way to sort of combine and cross that data together. All right, on to the questions. All right, let's see here. We got a couple questions already. Let's do that before we get to these. Where am I pulling these charts from? Some of them I screenshot off of Thinkorswim. Some of them I get from another piece of software. But really it's less about where the chart comes from than sort of what the chart says. So Ross, we do these workshops every 3 weeks, and do you foresee a slowdown in economic growth in the second quarter of 2022? I don't know what's special about the second quarter of 2022. Right now, I feel like things are pointed in the right direction. It really depends on some things like, can we get past the shipping crisis? Can we get more of some things produced and made? Does COVID stay low? Does the Fed not step in and cause a recession? I mean, the other thing to think about in terms of inflation and prices and all these shortages is, yes, people are willing to pay more for things because they have to, because they want the things and they're in short supply. But is there an interest rate that you can imagine that clears up that container backlog in Long Beach? Those things feel unrelated to me, right? Like, I don't think changing interest rates is going to move the containers around faster. So we have some things where, yeah, I mean, you can look in some places and say, all right, there might be some inflation here, but a lot of what we have is just sort of backlogs of stuff and shortages of things like shipping capacity, and I have a hard time seeing how higher interest rates changes that. So my kind of hope here is that the Fed can signal that they're on top of inflation enough to sort of keep it tamped down without raising rates too fast and causing a recession that may end up solving the inflation problem by, if a bunch of people lose their jobs, they're probably going to buy less stuff. But that's not really how you want to solve that problem. All right, so we got a question about AT&T. And this was, I think Marcin sent in a couple of tickets, and I sort of combined them and cleaned this up a little bit. But this is the gist of it. So analysts seem to like it. The dividend is high, but the stock keeps going down. And then also a report from Reuters that AT&T is the primary funding source for OAN, which stands for like One America News. It's sort of a weird third tier cable network. It's up in the very high numbers. I thought it was a telecom company with hardware. So it was. But AT&T and Verizon both made a lot of big bets on some non-telecom things in the last few years. AT&T bought DirecTV and then turned around and bought Warner Media, and they're now getting rid of most of Warner Media. They're spinning it into something in a partnership with Discovery, but they're taking a loss on those assets that they bought and now they're selling. Verizon also bought a bunch of content pieces, Yahoo, Huffington Post, etc. They sold a lot of that stuff off to, I think, the company that owns BuzzFeed, if I remember correctly. But yeah, I'm not 100% sure why they thought that was a good. I wasn't 100% sure why they thought that was a good idea at the time. DirecTV, I can see might make a little bit of sense, but the actual content assets, like the idea there is to have some sort of vertical integration play, but just never made sense for phone companies as far as I can tell. Both of these companies have a ton of debt, although AT&T does have sort of more on a, as you relate it to the rest of their balance sheet and cash flow statement. And it definitely seems to have made the sort of bigger bad decisions. Warner was a giant acquisition and they're selling it at a loss. I think the T-Mobile Sprint deal probably helps AT&T just because it means that there is one smaller player here that's trying to be disruptive as opposed to two. They're still probably undercutting them on price, but they don't have the network that AT&T and Verizon have. And yeah, the DirecTV piece is interesting. It is in the same way that cable television is a business in decline. DirecTV seems to also be sort of a business in decline. But I think too many people live in places where high-speed internet isn't available for DirecTV to go away anytime soon, right? So in the same way that, like, your cable television bill looks a lot, or your cable bill looks a lot different now than it did 10 or 15 years ago, in the sense of what I'm paying for is internet bandwidth and a landline telephone. And I'm not paying for the actual cable television programming. And so as people are able to sort of cut the cord and stream whatever they want, whenever they want, as opposed to watching shows as they come on at a certain time, I think you see the DirecTV business slide, but for now, I think it's fine. It throws off cash. It is what it is. And yeah, the OAN thing seems strange. It adds to their business in terms of having more content to sell to distributors. So the reason to own television production as opposed to just television distribution is, if I own television production and I have a channel that lots of people want, they'll ask their cable provider to add it, and then the cable provider pays me to redistribute that content. It's unclear if it was profitable or why they thought that was the best play, but yeah, I mean, I don't know. Vertical integration can work in some industries. Comcast seems to have kind of pulled it off in terms of owning NBC Universal and the distribution arm, but I feel like those things were bigger and scaled better as separate businesses, and tying them together, I don't know how much they really got from that. Honestly, I think Comcast kind of bought NBC Universal maybe a little bit cheap because GE wanted to get rid of it. All right, what do you think about BITO? So this is the new Bitcoin ETF that launched yesterday. There's a long article posted yesterday that's still on our news page. It's a way to track basically the price of Bitcoin. And the reason I say basically is, unlike some things like, so there's a gold ETF, GLD, that buys gold and sticks it in a vault or a series of vaults. And so there is theoretically $1 worth of gold for every dollar you put into the ETF. And if you sell your ETF shares, gold theoretically comes out of the vault. So here what they're doing is they're buying futures, which creates a bunch of sort of weird things, but it won't track the price exactly, right? So if you buy the Bitcoin ETF and hold it for a year, it will almost certainly underperform just buying and holding Bitcoin. That's because there's a management fee. There's some expenses related to rolling futures. I mean, the ETF will lose value relative to Bitcoin over time. If you feel like you need some Bitcoin exposure and you haven't figured out how to open a Bitcoin wallet or buy it through one of the, handful of online brokers that are, will let you just buy Bitcoin in your brokerage account, I guess this is fine. One thing I have noticed, granted, BITO has been trading for 2 days, so relatively small sample size. But the thing I have noticed is that spreads have been a penny, right? Like the bid will be, 43.48 and the ask will be 43.49, which means that on a transaction basis to buy and sell, it's going to cost you about a penny, right? Which is 0.2% of the price of the ETF. I compared the bid and the ask for actual Bitcoin on a couple of exchanges and, one of those online brokers. And the spread there is about 0.4%. So yeah, if you're day trading or doing some other sort of frequent in and out short-term trading on Bitcoin, the ETF might be a little bit cheaper. I mean, if you're not paying commissions, then what you worry about is this kind of thing where you're worried about what people call slippage, which is how much you lose between the bid and the ask per trade. So that tighter spread might be a reason for it. People are buying this thing like crazy. It's I think set the record for most assets gained. The fastest. What I forget what I don't know if it's a billion or what the number is, but people are buying it. I'm not exactly sure who didn't already own Bitcoin that wanted to, but it seems fine. It's gonna basically track the price of Bitcoin minus cost of rolling futures, plus I think it's a 95 basis point fee. But yeah, it's fine. If you like Bitcoin, this ETF is fine. And like I said, the trading thing does seem interesting, and there may be actually some value to it from that point of view. So Randy asked about outlooks for ASML and LG&D. ASML beat on earnings and missed on revenues ahead of the open today. This company makes equipment used to make semiconductors, but the problem is, right, supply chains. It might be worth keeping an eye on if you're interested in holding it for a long time, but yeah, it was down like 4+% today. I would kind of want to see that it had bottomed out a little bit before I bought in, but we can look at it over here. I mean, I don't think making semiconductors is a thing that's going to go away, and so the equipment used to make semiconductors, right? So there's a year. You can see the big drop today. Here, wait, it closed down. Yeah, 4.4% today. But if you look at 5 years, it's, absolutely gangbusters. The all-time chart is, almost crazy looking. Yeah, so I mean, as a long-term play, you might be getting close to a buying opportunity here. I don't like buying things the day after they report on bad news because a lot of times they go down for another day or two. The other side is sometimes they bounce back, so you might, trying to be perfect with that timing isn't great. But yeah, I mean, now might not be a bad time. It doesn't seem like people are going to go away from this process. I'm not super into this in terms of understanding was it their lithography or something? Yeah, photolithography for making chips. Yeah, I know how to pronounce those words and kind of what it means. Yeah, it doesn't seem like that's a process that's going to be obsolete anytime soon. So I think you're probably fine there. Yeah. Is it going to go up tomorrow? That's, 50-50. But yeah, I think it's probably okay as a longer term one. This one is interesting. This is a similar sort of company in the sense that they are a biotech, but in the same way that ASML doesn't make chips, this company makes sort of supplies for making medicine as opposed to trying to make medicine. And yeah, I know even less about how well these supplies are used or what they're useful for. What I will say is the chart is less inspiring. And even if you look at a longer term chart, right, this doesn't seem like a stock that, I mean, it's up over the course of this chart, but what it does a lot is go up and down more than it goes in any one direction. And the other thing I'd point out is if you compare it to, nope, home builders, say a biotech ETF, it has underperformed on, I guess it's beaten it over the last year, but it's definitely underperformed over the last 5 years and the last 6 months. So the year time frame is a little bit cherry picked there, it looks like, in terms of how that performance has worked out. So, and yeah, I don't buy any biotech stocks directly. I don't feel like I understand them or have a handle on what's going on there. I have traded in and out of the biotech ETFs once or twice when I feel like the whole, well, here. There was a big run up, sort of, around the time the vaccines were approved last year. And then everything sold off and it hit a point somewhere. Yeah, it hit a point where it seemed like it had sold off and was going to snap back. And so, yeah, I made a short-term trade here or there on things like that. But generally, I don't feel like I understand anything that's going on with this. They're doing very expensive science experiments, hoping to find things that are very profitable, but there's way more failures than there are successes, and so I tend to either be in the ETF or just not in it at all. All right, so I think that's the end of the questions I got ahead of time. Yep. Okay, so any other questions you have, you can throw them in the box there. We got another one from Ross here about coal stocks. Yeah, so the interesting thing about coal is everybody's trying to move away from it, right? So in the long term, nobody wants to be buying and burning coal, especially this side, right? High BTU, bituminous thermal coal. There's a different kind of coal that is used in steel making that people are, so far we need that to make steel. So as long as people are making steel, people are going to need that other coal. But the what they call thermal coal mostly gets burned in power plants, and everyone's trying to move away from it. So it is, I don't think this company's been around that long because they had a bankruptcy. Yeah, this company's only been around since 2018. There was another Consol Energy that declared bankruptcy, and that's why the charts on most of these, you think coal mining's a thing that's gone on for 200 years. It is, but none of the coal companies are 200 years old because a bunch of them declared bankruptcy a few years ago. And so, yeah, it may keep running up. I know coal was getting crushed in China earlier today. The price was, because they said they're going to reopen a bunch of things. I mean, I would kind of put these things in the same category as like tobacco stocks, in the sense of it's a business that seems to be in decline, but for now it seems to be a business that makes money. Where coal is different is it's exposed to commodities, so it's going to be a lot more volatile. And also this guy right here, it's not paying you a dividend. Whereas like a Philip Morris pays you 5%. Exxon, I think, is even higher than that. Yeah, 5.5. Right, people are also trying to move off of oil, but not as fast as they're trying to move off of coal. And so, yeah, as a trade, I think it's probably fine. As something I was going to stick in a portfolio and forget about, I don't feel like coal stocks is where I would want to be. All right, other questions? I don't know if anybody's asked it yet. It doesn't look like it, but somebody always does. There will be a recording of this available tomorrow, and we'll send you an email when it gets posted. It'll just be in the news section of the website. You can find it there, but we'll also send you an email with a link to it after it goes up. As interest rates go up, will finance stocks continue to do well? Uh, Potentially. So the thing about interest rates going up is, right, like as the yield curve gets steeper, the banks tend to do pretty well, right? They borrow at typically short-term interest rates and lend at longer-term interest rates. So if you have some steepening yield curve, that helps. Right. So if people are expecting inflation to be higher and it's low right now, or people are expecting rates to be higher in the future, but they're low right now, right? That sort of steeper yield curve helps. Also, the growing economy helps, right? I forget. Oh, it was one of the regional banks, maybe Truist, maybe it was PNC. They called out a lot of banks. Banks used to make almost all of their money from what they called net interest margin, which was essentially the difference between their borrowing costs and their lending. Right, so they loan money at higher interest rates than you borrow. You just make money just on that. It's easy money, as long as people pay their loans back. But interest rates have been low for a long time, so they've been, ramping up sort of fee income, right? So now you have a lot more fees on things. So one of the banks pointed out that, most of our money is from fees at this point. So really, they still do well in an expanding economy, but it's because people take out more loans, they buy more cars, they do a bunch of other things like that. And so, yeah, I think finance stuff will generally be fine, as long as the economy continues to be strong. I think they'll be fine. We don't currently have any concrete plans for ETF improvements. It's a thing we've banged several ideas about now, but we don't have a plan to slot it into an actual development cycle. Anytime super soon, but it is on the very long list of things that we would like to improve. Not sure. The question is, how do I find correlations between different option strategies and stocks or sectors? I'm not sure exactly what you mean there in terms of correlations. So, like, are you looking for an option strategy that will perform the same or better than stocks, or maybe do the opposite of stocks or a sector? I just don't understand the question. So industries that benefit from supply chain problems. That's a good question. Right now, it's things like, right, all those shipping and logistics companies. Right, JB Hunt is the one I talked about earlier. They can't find enough trailers to move all the stuff around that they want to move around, but their rates are higher than ever and their earnings were higher than ever, right? Like, what they're basically saying is, we're moving everything we can move right now and we can basically set the price. The only thing that's keeping us from making even more money is we can't find trailers to move all the stuff that people want moved, right? That sounds like a problem, and it is a problem. But the problem is basically we can't make unlimited money. We're constrained by these certain things. So it's really stuff like that in terms of benefiting from supply chain problems, right? It's the shipping and logistics, your warehouse REITs, that industrial REIT sector. A lot of that is like warehouses and self-storage and stuff like that, because people are trying to move stuff around and they don't have a spot for it. So that's what happens, is they have to pay to store it. All right, so best performing growth or value stocks within sectors. So growth and value are interesting as concepts, because what tends to happen is you have your growth sectors and you have your value sectors, and so there aren't a lot of, if you're a value investor, you may be able to find something in the technology space that meets your criteria, but generally you're not going to be buying a lot of software stocks as value plays. Microsoft maybe has hit that category at this point, but even then, I feel like their PE ratio is pretty high. Yeah, PE of 40 isn't really anybody's idea of a value stock. Right. So really, growth sectors are things like your biotechs, your almost everything in technology, right? Stuff that's growing really fast. Whereas value is, right, think of one as growing really fast and one as running a business very efficiently, right? So like something like a Coca-Cola, right? Like, they're growing, they're, finding new ways to sell you drinks, and as actual sort of, according to Hoyle, soda has sort of declined in popularity. They sell a lot more Gatorade and flavored waters and stuff like that now, right? Those aren't necessarily, there's not a ton of growth in Coca-Cola, right? Like, Coca-Cola isn't going to invent a new kind of beverage tomorrow that is just going to take the world by storm. They're not going to grow revenue by 25%, for several quarters in a row, which is the kind of things that you look at for growth stocks is rapid growth, right? That's, tech stocks, like I said, biotechs, that kind of thing. So really it's just an issue of like which sectors are which, as opposed to trying to split out growth and value in a different sector. And a lot of it comes down to, at this point, like who's making stuff versus who's making services. I think we've all learned from the pandemic that it is super duper hard to suddenly produce way more stuff, right? If you're running a business that sells stuff, you can only ramp up production so fast. Whereas if you're selling software, right, a thing we talk about here a lot is how much does it cost to sell one more version of Microsoft Office, right? Like how much does that cost Microsoft? Nothing, right? There's no Microsoft Office factory. Making 10 copies of Microsoft Office or 10,000, they've made the software. They make it once. So at that point, every unit you sell, your cost goes down. Whereas, if you're moving stuff, you've got some industries, some economies of scale can be realized from production, but you still have to ship things. You still have to, make them physically. So it's just a lot harder to do that. So that's really what that sort of growth and value split is about, is those sorts of things. So industries that benefit from the chip shortage, I mean, the chip makers are doing okay. I feel like they're maybe a little bit closer. They're the closest thing we have to a beneficiary, although Taiwan Semiconductor makes a lot of chips. It's not really going anywhere. And the problem is, it's cool if you can sell every chip you make, but the way you grow is make more chips. And so everybody kind of has this problem where NVIDIA looks a little better, but even then it hasn't really gone anywhere for 2 months. Yeah, I mean, the AMD looks about the same as NVIDIA. It hasn't gone anywhere for a little bit longer. That's one of the things where I'm not sure, to be honest. Like, it's hard to figure out. Intel just hasn't gone anywhere for 5 years. Or let's call it 3 years. Anyway, yeah, that one's just hard to find a beneficiary from. I think the chip stocks are going to be in a good place when they can get production ramped up, because everybody's going to want as many chips as they can make. And so over the long term, right, it's the chip makers. In the short term, I don't know. It's it's whoever can get chips, right? Like, I know Apple stock was down because they, have to scale back their iPhone production plans. But TSM is not going to cut Apple off. So Apple will be okay. They may not be as good as they could have been, but I think they'll be fine. Companies that are on a smaller scale than Apple, some of those people, TSM may say, hey, we got an Apple order to fill. You're going to have to wait. So that's really just a list of who loses less, I realize, but this is one that I've tried to find winners from, and it's tough. People who sell used cars is really probably the best answer I can give you there, because shortages have made it hard to get new cars. And so if you look at used car prices, they've just gone bananas. That may be the closest thing I could come up with for a winner there. The pot and psychedelic stocks, those are two very different things. I understand why you put them together. Psychedelics, there's a lot of people doing research on like ketamine and magic mushrooms for treatment of depression and things like that. And it may turn out to work. It's biotech as far as I'm concerned. They're doing expensive science experiments. and it may or may not work. I don't know. The marijuana stocks, I think, are more interesting. Legalization is coming on in more places. They're selling things, selling more and more things sort of legally. Canada is, I think, fully legal now, but they have some interesting structure to their marketplace. But yeah, I won't say 100% sold on just all the pot stocks, but I do think, and I think marijuana is going to go, at some point it's going to transition from growth to value, right? Like as new markets come online, it's absolutely a growth stock, right? Like, if suddenly it becomes legal in, all the states in America where it isn't currently, that's a huge growth opportunity, right? But at some point shortly after that, well, now you've captured all the users. Now what you're trying to do is, right, it becomes Coca-Cola at a certain point, right? It's a thing where everybody knows where to buy it. The people who want to buy it can buy it. And so now what you're competing on is, marketing, price, coming up with interesting new products, strength of brand. And it becomes a much less exciting business. I think it has potential to generate a lot of cash in the same way that, Coca-Cola or something does. Don't get me wrong. But I think that growth to value transition happens relatively quickly once you reach a sort of plateau. Now, if states come online one at a time in terms of legalization, you're going to see a slower but longer growth trajectory. But yeah, at a certain point, right? I mean, there's nobody in America who has not had a Coca-Cola who wants one, right? And you say the same thing for, a Budweiser. Well, I mean, maybe some kids in middle school haven't had a Budweiser but would like one. The same thing is going to be true of these various pot products at a certain point, relatively shortly after legalization. And unlike Diet Coke, I've known people who drink 12 Diet Cokes a day. There's a limit to how often you can, how much marijuana you can consume and keep yourself in a position where you can keep paying for more marijuana, right? Like, yeah, just being really high all the time is a great way to lose your job, which makes it really hard to keep being high all the time, I guess. So I think there are potentially some problems there, but I do think it's an interesting spot. And I think the marijuana stocks are less speculative than the psychedelics. But I don't really have a lot of coherent thoughts there, as you can probably tell from the fact that I just sort of babbled at you for a while. Anyway, thank you all for coming, especially those of you who hung on this long. Like I said, that recording will go up tomorrow. Thank you for subscribing to Investors Observer. Next one will be in 3 weeks, which is November the 10th. Yeah, all right, thank you. Bye.